Good afternoon and welcome to a new virtual investment summit by Fund Society. Thank you very much for joining us. I know you are all very busy. These are very challenging times. And I have to say that I am very excited. I am really happy because today we have a very special event. On one hand, we are going to talk about the future, about 2021, about how to build resilient equity and fixed income portfolios in these times, which we all know that are challenging and difficult. And we're going to do that with MFS and 91. And the second reason I am very happy is because today we have two legends of the US offshore and Latin America fund industry, which are José Corena and Richard Garland joining us. And it is really going to be a very interesting panel. Before we proceed, I want to remind you that there will be a Q&A session after the presentations, and you can post your questions through the WebEx button at any moment during the panel. You can post them in English, in Spanish, we can translate them for you, or if it's easier, you can also send us your questions to info@fundsociety.com, and we will share them with the panelists. And now, without any further ado, I'm going to introduce our first guests. It's going to be MFS. MFS is going to talk about fixed income. José Corena, hello. Thank you for being here. And Brad, also, thank you for being here. Jose, please talk about MFS and your efforts in fixed income. What are you going to talk about today?
Well, Alicia, thank you very much, and welcome everyone. And I appreciate you calling Richard and I legends, which is a nice word for old and maybe going into the fossil world. But we're very happy to be here. As a matter of fact, I want to thank you, Fund Society, for organizing this event. I know there's been a series of events that have been very, very good for the industry. Since the COVID, sort of crisis came in. So we really appreciate your support to all of us. And I'm delighted to partner with and our friends from 91 for this event. I mean, I've always often say this, I don't see and I don't view ourselves as competitors. We are rather collaborators for the sole purpose of providing choice and consistent alpha generation for all of you, your clients and your portfolios. So I think at the end of the day, that's really important to highlight. And we're very excited to be a part of this. Now, in regards to MFS, I mean, for almost a century, our purpose has been very clear, which is really responsible active management. And why is that? Because, MFS as an investment manager really exists to allocate capital responsibly and grow clients' assets across every single asset class. We strongly believe this to be important, especially when we think now about the great topic of sustainability and invest in creating a sustainable approach in creating long-term value and positive outcomes for our clients. We've done this, for almost a century, by following a philosophy that aligns clients' objectives with responsible integration of sustainability factors, also a process that really emphasizes on financial materiality. And more than that, also is a culture that thinks, engage, and invest, looking at the lens of sustainable long-term value. And I think that's really key and important. Now, what we'd like to do is I like to, just use as much of the time as we can to have our speaker, Brad Rutan, kind of go through a presentation that I think is very timely. So what I'd like to do is maybe introduce our speaker first. It's someone that if you've been in the industry for the last 15 or so years, you know Brad Rutan for his extensive travels out in the region. He's not only a great friend to distribution at MFS, but also a great friend to all of the folks on both the buy and sell side. Brad's a CFA and is a product specialist and managing director that leads the retail fixed income product effort across the globe at MFS. He works closely with all the PM teams, the research analysts, the quant team, and is responsible in communicating our philosophy, the process, the positioning of all of the MFS fixed income portfolios across MFS. He joined MFS in 2006. And previously, he also was a senior investment product specialist on the growth side. So he has both the equity and fixed income side that really brings in quite a bit of a great mix when we talk about, sort of the market overall. So we're very excited to have him here. And what I'd like to do is, before we jump into the presentation, I'd like to have you, Alicia, just show a quick video that I think will do a great job of setting the stage of what Brad's going to talk about, and I think that will get us right into exactly what this presentation is all about. So thank you everybody for joining, and Alicia, please show the video.
What we want and what we need are rarely aligned. For instance, what I want to eat versus what I need to eat are two very separate things. And I think today, fixed income investors, their wants and needs are misaligned. They want higher income, higher yields, but in our opinion, this late in the credit cycle, their need is for bonds to act like bonds and diversify away their equity risk. This doesn't mean you have to hide out in CDs or treasuries, but as an active manager, it's our job to assess where we are in the credit cycle and know when to pull the various investment levers we have at our disposal. And these levers could be active decisions like increasing credit quality or interest rate sensitivity, or relying more on sector allocations or security selection. Just as every stage of your life requires a different approach, it's no different with fixed income investing. When you're young, risk-taking might be rewarded versus an older stage of life might require more caution. Passive fixed income investing is very useful to take advantage of one stage of a cycle, but for long-term investors, the skills and diversity of investment levers that an active manager like MFS could bring is essential.
So, Jose, Brad, I need like 30 seconds to put on your presentation, and then you can just begin, okay?
That's great,
Brad,
Alicia.
welcome back.
Thank you, Jose. I apologize for the technical difficulties there. Let me just start by saying that I think as kids, we think we control a lot more than we do. And that's why parents are always cleaning up after their kids. But as we age, I think we become more cynical and realize, how little we control in our world. You don't control who catches this virus. You don't control who gets sick or really a lot of events in life. And it's the same in the markets in that you have no control over inflation. You have no control over your country's interest rate. You have no control over what the market does to react to a tweet. And today I want to talk about the winds of change that we're seeing there out there in the markets. And
Okay.
Alicia, are we going to put the presentation up?
Sure, yes, it's ready. There you are.
Perfect. And these winds are events that you can't change. But that does not mean you can't benefit from them, and I'll get to that. The biggest wind out there is obviously what I call the Tornadic Winds, and that's the fiscal monetary impulse of central banks. If you could go to the next slide. We've obviously seen a crisis, and in response, we've seen governments, central banks respond like they never have. I compare the fiscal and monetary to GDP, so we can compare different countries. I put in the GFC 08-09 crisis in light blue. Let me remind you, that was an all-time record. And all we've done this year in the United States is double it, triple it. Some countries have 4 or 5 times it. This will go down as the greatest fiscal monetary experiment in the history of mankind. But just because they promise to do certain things doesn't mean they're going to do it. And if you remember the movie in 1995, The Usual Suspects, a great ending movie, one of the greatest endings ever. Kaiser Soze, the bad guy, my favorite quote of his was, "The greatest trick the devil ever played on the world was convincing us that he never existed." And Alicia, if you could go to the next slide. I think the greatest trick the Federal Reserve has ever played on the world is convincing us they were going to spend trillions in these programs. Yes, they bought trillions of treasuries and trillions of mortgage-backed securities. But these programs on the left, those bars are what was authorized for them to spend. Those little blue lines, that's what was actually on their balance sheet as of 9/30, September 30th. And it hasn't really changed. This is the announcement effect. We'll do whatever it takes, is what Mario Draghi said. And this is the Federal Reserve's moment where they came out and said, we will do whatever it takes. The reality is the announcement was much more important than them actually doing it.
Hey, Brad, a quick question for you, if we can add, just because something interesting on slide number 3, which just looks at China and the way that they responded today versus how they responded on the GFC. It's really interesting to see that they basically, yeah, there it is.
Yeah, look at that, Jose. I mean, it's the only country in the world, right? It's the only country in the world that's thrown less at this than they did in 08, 09. The only country. And I apologize for cutting you off, but the reason is that they created a housing and a debt bubble in 08, 09 by easing so much that they've been very hesitant to do the same this year, and they've really held back on what they have done. So that's the Tornadic Winds. If you could fast forward to 5, and then I think we're going to just go ahead to slide 6, Alicia. So Tornadic Winds are central bank policy, and that's might change under Biden, under different regimes in different countries, but that's here to stay. And we need to account for that in our fixed income portfolios because they pick up everything. Tornadic winds are the strongest winds out there. They pick up everything. And that's what central banks are doing. Let me move to the mountain wave winds. What mountain wave winds are is when wind comes up one side of a mountain very smoothly, and then it goes down the other side very roughly, turbulent, violent, if you would. And as I think about the issuance of credit, corporate bonds the last 20 years, they've gone up one side of the mountain very smoothly. They've issued bonds and everybody's eating them up, right? I want that yield. I'll buy it. They've been oversubscribed 10 times. What we're worried about is the other side of the mountain as we come down and the problems are become visible. Next slide, Alicia. You can see here, these blue bars are what was issued by U.S. companies. I apologize, this is U.S. The last, call it 25 years. So each bar is how many billions of dollars. You can see the lines, which are the averages pre-crisis and post-crisis, those light blue lines. And it doesn't take a math major to realize that we've tripled the amount of debt that U.S. companies have issued. That line on the far right for 2020 is 8 months worth. We set an all-time record for bond issuance in the United States in an 8-month period. The problem is that green line there. That green line, to be overly technical here, is the average age of company stuff in the United States, their technology, their equipment. That age has never been older in 65 years. So congratulations, you issued a ton of bonds. What did you do with that money? You sure as heck didn't sink it back into the company. And because of that, if you go to the next slide, we're seeing the average, well, this isn't going to show it, but what this would have shown you if the formatting had worked is that the average credit rating of almost every sector listed here is at a 20-year low. Forget about what you're seeing. The average credit rating of almost every sector you see here has never been worse than it is today. Because of all this bond issuance, the leverage ratios are higher than we've ever seen in many of these industries. If you could fast forward to the next slide, hopefully the formatting works on this one, slide 9. Pretty good, not bad. What we're showing you here is what we call the recovery rate in high yield bonds. When you invest $1 in a high yield bond that ends up defaulting, company defaults on its debt, you actually don't lose all your money. You lose a portion of it. On average, you see that long-term average, on average, you get 40 cents back on the dollar. And you can see what it's been each calendar year going back to 82. If you look on the far right, the last 12 months, we just set an all-time record for a low. 15 cents on the dollar you're getting back on defaulted high yield debt. This is the other side of that mountain where we're seeing a lot of the stress in the credit markets come to fruition. And investors, we feel if you're not very selective on what you own, you're going to feel the pain in some of these sectors where credit ratings are so low. If you could fast forward to slide 11, Alicia. There you go, right there. Let me talk about wind shear. Wind shear is when two weather zones are side by side and the wind from one zone hits the second zone and it literally tears or shears off in another direction, in another speed. It's called wind shear. And I don't think anything is torn or sheared at the fabric of our society today, at least in the United States, and again, Argentina, I've been down there this year, other countries as well, than politics. And when you look at the US presidential election, if you could fast forward to the next slide, one thing we measure over time, this formatting is a little tough as well. Let's fast forward to the next slide just to get past this one. There we go. Let's talk about the two candidates that we had, because with Biden winning the US presidential election, I think it's very important to understand that his policy platform is very inflationary. Maybe not as inflammatory as Trump's, as some people would say, but it's very inflationary. A red arrow up means that that policy goal would cause inflation if it were implemented. And when we think about this, this is something we have to take into account because we have all this massive fiscal monetary spending that should be inflationary, that will be inflationary someday. You add in a presidential candidate that has an inflationary platform, and there's things we need to worry about. Or do we? Because look at the next slide. Look at all these presidents going back to 1916 and the main policy goal that they ran their campaign on. And you can see on the far right what actually happened. A lot of them said, well, we're not going to go to war ever. We'll never send our boys to Vietnam. We'll never raise taxes. All these were essentially lies or mistruths, because once they became president, those promises went out the door. So just because you ran on inflationary policies doesn't mean they're going to happen. And the last slide on this section, if you could fast forward to 15. So some of you might say, well, once he gets in office, what he says then matters. I don't know, does it? Here's the percent of, going back through Obama, what percent of their State of the Union speech, biggest bully pulpit in the country, stand up in front of everybody and tell you what we're going to do. Well, 26% of what's said at a State of the Union speech actually gets done. Another 13% gets partially done. That means that 61% of what you hear out of their mouths, while they're up there speaking to everyone, never crosses the start line, let alone the finish line. So I'm not sure politics matter as much as people think. Yes, there's going to be some sectors that are better off and some that are worse off. But I think we should caution about getting too far ahead when it comes to politics. Let's fast forward to the last section. And that would be one more slide, please. Yep, right there. I call it the trade winds. Because the trade winds were these constantly easterly blowing, or they still are, they're not were, they are, winds along the equator that allowed settlers from Europe to reach the New World, to reach Latin America, South America, North America. And it was a great step in globalization. Maybe we can question how great it was for the people that lived there, but as far as globalization goes, it was a major step forward. And if you look at the next slide, you can see that really over the past 200 years or so, and I apologize, this formatting is wrong as well. Don't look at the chart. We've seen an incredible couple waves of globalization, especially these last two. And it should show two separate stages of globalization. Just understand this. Forget the chart. Ever since the 50s, we have been increasingly a globalized world, a smaller world, because of better technology, communication, transportation. If you could go to the next slide, what's not to love about globalization? Why do people push back on globalization? Look on the left there. The amount of trade in the world has gone hyperbolic since 1950. The percent of the global population that's not living in poverty, or that is down from 90%, used to be in poverty, now less than 10% of the population is living in poverty. So then why do I constantly hear about globalization as a bad thing? Well, I figured it out, and I'll end with a couple slides here. It all comes down to one animal. It comes down to an elephant. And if you could flip to slide 20, I'll show you that elephant. Hopefully you can see the shape of an elephant here. Let me describe what we're seeing here. If you took every person in the world and ranked them by their income, how much they make, and ranked them on the bottom there, poorest people on the left, richest people on the right. That vertical axis, if you took those same people and measured how much their income went up or down because of globalization in the last 20 years. So if you're high in this chart, you benefited greatly from globalization. If you're low, you didn't benefit at all. Last thing are those letters. Who are those letters? 4 groups of people. You ready? A. A would be sub-Saharan African, emerging market countries where you really have not benefited. The government stole the commodities, or they just haven't benefited from globalization. They're the poorest people in the world, and they haven't benefited at all. B would be emerging market countries, Latin America, Asia, that are in the middle of the income distribution, maybe slightly below, but they have benefited greatly from globalization. It's been a very good thing. Let me fast forward over C to D. These are the richest people in the world. It's the people that own the companies and own the stocks, and they've are very rich and they've benefited greatly. So they love globalization. Who's C? C would be middle class America, middle class Europe, developed countries with a middle class where globalization has turned against them. And it's caused a lot of this nationalism and populism in the world and inward looking. And if you turn to slide 21, you'll see that the number of trade conflicts out there has grown exponentially. All these countries are red now. But where's this really coming from on slide 22, Alicia? It's all coming from the United States and Europe. All this nationalism, populism, inward looking is coming from the 2 areas with these massive middle classes that see globalization as not a good thing, but a very, very bad thing. And that's why we're seeing the world start to deglobalize. Now, I'm not rooting for deglobalization. If you could turn to slide 23, I want to tell you why I think if it does happen, it's not the worst thing in the world for companies like 91 and for companies like MFS. And let me explain. On the top chart, what I'm trying to show you is the standard deviation of growth in the world. Let me explain. If the point is high on the chart, that means you have great dispersion between GDP in the world. Some do great, some do poor, and everywhere in between. But look at those 3 periods of globalization you see there. What happens? Everyone's outcome is about the same. Everything gets pushed together. There's no difference between company A and company B, country A and country B. And then you see in the bottom what's also happened in those 3 periods of globalization is inflation has been crushed. Cost has been sucked out of the system, and everyone's inflation is roughly the same. So if we do see globalization end, we should see these outcomes change. Much more greater degree of dispersion between growth, greater degree of dispersion in inflation, and then greater outcomes out there. So 91 and MFS can choose company A over company B and add a ton of alpha. Country A over country B. What I'm trying to get at here is that you can't change these wins. There's nothing you can do against them. But what you can do is adjust your sales. That's what 91, that's what MFS does. We adjust our sales based on what is going on out there, these massive wins that are happening. And if you could fast forward a couple slides, one more slide to page 30, I'll end on that one. Because I think there is a solution to this storm with MFS, and that would be right there, Alicia, the MFS Global Opportunistic Bond Fund, Meridian Funds Global Opportunistic Bond Fund. Listen, I have no time. I want to end in 1 minute here for process, to tell you about the team and the rigorous process and risk management, all that. Let's get to the alpha. On the left, that's 1 year rolling periods. If your dot is above the line, we added alpha. We added excess return. If it's below the line, we didn't. There are going to be 12-month periods where the market moves against us, period, always. But you give us 5 years on the right, or 7, or 10, and every single period, we have got you alpha to the tune of about 2% gross of fees, 1.5% net of fees. We invest for the long term. We think for the long term. We think about sustainability, and that's what we do. And if you can give us the time to extract the alpha from the market, you can see here, no matter what winds are happening, we can adjust our sails and provide you with a portfolio that's done very, very well historically. Let me stop there. I know we're a few minutes over, Alicia and Jose, and see where you want to go from here.
And if Richard is ready, and we can go into the equity side of the presentation after your introduction. Yeah, there you are, Richard. So let's go to the equity side. Richard is doing a presentation about 91. We all know about their global franchise strategy. They're very well known for it. And I think that you're going to be talking about this, about global equities, quality global equities. So yeah, please go ahead.
Okay, Alicia, thank you very much. I want to pick up on what Jose said about legends of the industry. Whilst, you know, Jose may be very old, I'm actually not that old, so I'm not sure why the word legend was used. But I am delighted that we're doing this event with MFS. I couldn't agree more. It's all about collaborating, about helping our clients, be they clients of MFS or clients of 91 or even other managers, help them with help their end clients meet their financial goals. So I love the fact that we're doing this with MFS. So what we're going to talk about today is we're going to talk about equities, not just global franchise. We're going to talk to you about why you need to invest in quality companies around the world because of their defensive characteristics. But we have a video. Now, our video does not have Brad in it from MFS, and I'm not even in it. So I'm just going to have to pass over to Alicia, who's going to show you our new ad all about 91. Awesome. Thank you very much, Alicia. So why did I play that video? Because to remind you that we used to be Investec Asset Management. We are now called 91. For those who don't know what happened, let me tell you, we had to get divorced from our parent, Investec Group. We demerged. We were like a young adult leaving home. So we were part of Investec Group for 30 years. And now we're an independent asset manager listed on the London and Johannesburg stock exchanges. So we are completely independent now, and all we do is asset management. Why is that important for you and for your clients? Because our interests are completely aligned with yours. We also happen to be owners of the company. 21% of the shares of the equity of 91 is owned by the employees. So our interests are completely aligned. And just to remind you, we began in South Africa 30 years ago. So we've very much grown out of an emerging market, which means we tend to look at the world slightly differently. So the new logo is 91. The new name is 91 because that's the year we were founded in South Africa. Now, one thing you may have noticed with our new logo is there's no zebra, which that's been a bit of a problem for many people. I have so many zebras at home. I got so many cuddly zebra toys. It's a bit of a challenge for me. So I can't use them anymore. So if any of you want any zebras, please let me know. But what we do have, if you look closely at the logo, we have our new stripes. So you can see there's stripes in the logo. So we haven't completely said goodbye to the zebra, even though, as you can see here, these are green stripes. So Investec Asset Management is now 91. We run about $150 billion, all invested all around the world. Particular expertise in emerging markets, but very strong expertise in global equities. So what I'm going to talk about briefly is our quality capability, and then hand over to Charlie. So Alicia, that's the slide I want. So now we don't just have one investment philosophy at 91. We have many different investment teams. On the equity side, we have a 4-factor team, which runs some of the funds you know very well, like our European Equity Fund, our All China Equity Fund, our Asian Equity Fund, and we have even a value team. But in the middle, we have our quality team. Now, the quality team does not just run one particular fund, it runs a complete suite of funds, and it's very much a global platform. So actually, it started in South Africa, almost 15 years ago when Clo started running our global franchise fund. But we are now very much a global platform with portfolio managers in Cape Town, in London, and also in New York. And you can see here, there's a total of 29 people in our quality team, and they run about $17 billion. So what we're going to talk about today is 2 of our funds, which if you go to the next slide, I'll show you. So we're going to talk about our global franchise fund, which so many of you own and know. Now that just, is available as an offshore fund. It's also available as a domestic 40 Act fund, and it's also available as an SMA. Now we have an international version of it, which is available currently just as an SMA. So that's global ex-US. And then on the regional side, we have American franchise, Asia Pacific franchise, we have SA, South African strategies, and also UK strategies. But the point I thought I want to leave you with before I pass to Charlie is that if you believe in a quality approach and you know global franchise, you should love what we're doing in America. You should love what we're doing in Asia, because it's the same approach. And what it gives you, in our mind, is it gives you some certainty in this very uncertain world. So Charlie Dutton is based in Cape Town. He is English. He sits next to Clyde Russo. So, he's sitting next to the great man himself. He's been at 91 for about 3 years now. He is the sole portfolio manager on our Asia Pacific franchise fund, but he works as a member of the integrated global team. He convinces Clyde sometimes to buy some of the Asian companies, which he researches. And what we're going to talk about, he's going to talk about today, is not just global franchise, but something very exciting, which is also his Asia Pacific franchise fund. So Charlie, over to you.
Brilliant. Thank you, Richard. Great introduction. Alicia, if we could have the next slide, please. So I don't really need to go through the macro uncertainty that we're facing at the moment in terms of where the economy is going, what's happening with technological disruption, climate change, geopolitical risk. But clearly, when you look at what's happening with the VIX index recently and what's going to happen very likely in 2021, is that increased volatility is going to increase. So when we move on to the next slide, what we're going to present on today is why we think that the quality approach and the 5 key attributes that we look for in quality is so important to taking some of that market risk away. So when we look at companies, and this philosophy applies across all the strategies that Richard just mentioned, that these are the key things that we look for. We're looking for businesses which have hard to replicate enduring competitive advantages. I mean, it could be branding, it could be the network effect, it could be a distribution effect, but basically they're very hard to replicate. We're looking for stocks which are dominant in stable growing industries. So they've got to be the leading market share position in a stable and growing industry. And the great thing about those 2 first points is it means that the third point then comes into play, which is that there's a low sensitivity to the economic and market cycle. I don't want to be sitting here and explaining poor performance in the fund because oil went to $60 and we were expecting it to go to $40, or that Chinese GDP growth was 4% and we thought it'd be 7%. We want to take that risk away. We want to be involved in businesses which are independent of the economic cycle. They've got to also be businesses with healthy balance sheets, strong cash flow, low capital intensity. And what they then do with that cash is vitally important. Are they reinvesting it at high rates of return? And do they have good capital allocation? We want that capital to be coming back to you as shareholders in the form of dividends or share buybacks, or reinvesting in the businesses at very high levels of return. If we move on to the next slide, if we get this right, this is the pattern that we will receive from the funds that we run. The top left-hand slide chart here shows cash flow conversion. Very simply, this means for every dollar of net income that we get, how much cash flow do we get? And you can see that actually for every dollar of net income, you get $1 of cash flow. The bottom left-hand chart shows that we don't use, or we don't like companies with high levels of leverage. You can actually see that currently, Global Franchise Fund is a net cash position. The bottom right-hand chart is taking that cash, and what's it doing with it? Well, it's reinvesting it at incredibly high rates of return. So the return on invested capital there is significantly higher than the market. If you invest at high rates of return, you get the top right-hand chart, which is good free cash flow growth. And you can look back over the last 10, 15 years and see that this fund will grow its US dollar cash flow base at between around 10 and 12%. Now you also add on dividends and share buybacks to that, and you can see an annualized US dollar return between 10 and 15%, assuming valuations stay the same. Can we have the next slide, please? What's also important though, so on the left-hand side here, is that these businesses are investing for the future. Yeah, extraordinary, that's 4 times as much R&D is spent by Global Franchise than by the average stock in MSCI ACWI. That means it's investing for growth for the future, but it's also reinforcing the moats of these businesses. So the structure that they have in place is being reinforced so that they can't be disrupted. On the right-hand side, as you might have guessed, we don't really buy cyclical industries. We don't buy heavy industry. We don't buy resources. So as a result of that, although we don't set out as a sustainable fund, you'll see that our carbon intensity is extremely low, but also we have great sustainable characteristics within the fund. Next slide, please. So, as a brief summary on Global Franchise, we think it's a differentiated philosophy in the sense that we are very much focused on those key attributes on those stocks, and we do not focus on other positions in the index. It's a high conviction portfolio, normally running between 25 and 35 stocks, currently just under 30 stocks. It has a fantastic track record of long-term outperformance, and we can look at that in a second. But it's achieved that outperformance by much lower than average absolute volatility. And the result of this is the catch line we use there: seeking greater certainty in an uncertain world. Let's now give you a bit more color about the portfolio. Next slide, please. You can see here that on the left-hand side, it looks like it's a very much North American and European dominated fund in the sense that that's where the companies that we own are primarily listed. However, the right-hand side will show that actually the underlying revenue exposure is very much globally diversified. And particularly with looking at that growth that we've got coming through from for Asia and LATAM and the rest of the emerging market. Now, the reason we have this split is, and it is a large generalization, but a lot of the corporate governance that we've seen in North America and Europe has by and large been more shareholder friendly than, let's say, emerging Asia. We are seeing an improvement within that space, but at the moment, we prefer to protect clients' money with that improved corporate governance, or until the improved corporate governance comes through from Asia. Next slide, please. I think this is very important, and again, you can see the type of stocks that we're invested in. It really is a focus on consumer, information technology, and healthcare. You might ask why I've left out financials there. Just to be clear, we don't own banks. The financials represented by that segment there are primarily the likes of S&P, Moody's, Visa, MasterCard, very much different from your standard high street bank. The right-hand chart will show that although we are a buy and hold strategy, we are active as well around that. So it's low turnover, not no turnover. And what's particularly interesting here is if you look at consumer staples as an industry, it used to be the mainstay of the fund. Stable returns, good growth, good cash flow generation. Clearly what's happened in the last decade is massive digital disruption. We've had to adapt to that. And you've seen the consumer staples exposure within the fund has dramatically reduced and information technology has increased. You're automatically going to assume that that's because of our FANG exposure. And please can we move on to the next slide, please? Just to be entirely clear, FANGs are not a component of the fund, okay? And I can go into those in detail, and maybe it's an interesting question to bring up in Q&A. But a lot of the FANG stocks don't meet the financial characteristics that we like. When you look at that increase in information technology within the fund, it's actually in very, very specific niche products within technology. Companies like VeriSign, they own the domain .com and .net network. So if you ever want to go off and get .com or .net registered, you have to go via VeriSign, and they will charge you for that. Companies like ASML, they actually make the semiconductor chip machines which are required by the likes of Taiwan Semiconductor and Samsung. So very niche industries. You'll see here it's an extremely concentrated portfolio at 51%. Next slide, please. Again, back to the point I was just highlighting then, and this is where we're particularly pleased with the performance of the fund, that we haven't just been beta players on FANG stocks. We don't own the likes of Apple, Amazon, Alphabet, Facebook. Those are the stocks which, in large part, in our eyes, actually have relatively poor business models. I'll just give you some examples there. Something like Amazon or Netflix or Tesla, and don't get me wrong, these are fantastic businesses in terms of what they've managed to achieve in relatively short periods of time. But the reason we don't invest in them is we're not sure what the see-through economics on those businesses are going to be on a long-term basis. And as a result, we don't have clarity on the valuation on those businesses. So you look at our top 10 stocks, and we have great clarity on where those businesses are going to be on a 3, 5, and 10-year basis. And the result is that we get extraordinarily high active market share of 93%. Next slide, please. So what does this mean in terms of performance? We very much invest on a absolute basis. We've never bought a stock because we think it's going to go down less than the market, or it's going to go up less, or up more than the market. We buy it because we believe these businesses are going to compound on a long-term basis. And the return profile of the fund clearly indicates that. The years we'd really like to focus on would be like 2011, 2015, and we were disappointed in 2018 that we didn't continue that record of achieving positive years over the last decade, even when the index has had negative years. And if we move on to the next slide, please. You'll see that what this fund really achieves and the way it's generated its alpha over the last 15 years has been during falling markets or during moderate markets. And we'll put our hands up right now that when you get a sharp escalating market, when a market does a sharp rebound as it did post the presidential election when Trump got elected in, and you saw bank stocks and oil stocks sharply accelerate, you will get a short-term underperformance. The key with this business is that on a long-term basis and on a long-term duration factor, you'll see that the performance comes through because of the outperformance it generates during moderate markets and falling markets. Next slide, please. So that's global franchise that we've now talked about. And I'm going to just now move quickly on to Asia Pacific franchise. And again, I'm not going to go back through what we're looking for in individual stocks, because this strategy follows exactly the same strategy as global franchise. We're looking for the same attributes in stocks. So just as a reminder there, that's these hard to replicate competitive advantages. It's the ability to have a dominant market position. And then the one which might surprise you with regards to Asia is we don't like economic cyclicality. You might say, well, hold on, Asia is very cyclical in nature. Is it possible to apply this type of approach within Asia? And I would say that 10 years ago it wasn't. But now if I look at the current environment and you look at the current stocks available in Asia, I'd say that now you're able to buy structural growth in Asia, which will perform through the cycle. I'm going to repeat that. Buying in Asia now is possible to buy structural growth through the cycle. You don't need to time investments into Asia anymore. I think you can buy structural growth. And there's been some key themes which have meant that this quality universe has actually expanded quite significantly. You've seen the emergence of consumer in Asia, and that's both through local brands and the entrenchment of international brands. The likes of Colgate, Unilever, Nestle, they all have local listings in India, Malaysia, Indonesia. But the local brands are also coming through and proving globally competitive. Companies like Samsung and TSMC, which were pretty low quality cyclical businesses 10 years ago, now absolutely dominate their sectors and have very, very strong financial characteristics. It's amazing to understand that actually this year, China is going to spend more in R&D than America on a cumulative basis. The result is that you're going to get some first-class individual companies coming through with niche products which are beginning to be competitive on a global basis. Again, those are the types of businesses which perform through the cycle and aren't cyclical. And finally, I think the Chinese government obviously took a look at somewhere like Europe, let's say, and went, well, hold on, we don't actually have any internet companies in Europe. Amazon, Google, Facebook, etc. have come in and dominated the internet space in Europe. So the Chinese authorities went, we want to create our own dominant players. And that enabled the Chinese firewall to be put in place, which enabled the likes of Tencent, Alibaba, Ctrip, Baidu to get very, very strong positions and actually now be globally competitive. Next slide, please. So when you look at the portfolio breakdown for Asia franchise, as expected, it's got a very, very distinct sector breakdown, focused on consumer, focused on IT, focused on healthcare. The country breakdown, we try and create as much diversity as possible to distribute the risk across the region. But again, there is a focus on China in particular, because that's where the opportunity set currently lies. Next slide, please. And you'll see here that it's an extremely concentrated portfolio. 57% of the portfolio is in the top 10. This is a high conviction portfolio, which has very strong financial characteristics and very strong growth prospects as well. Next slide, please. And although this is a short time frame in terms of the inception, and we do have an OIC which has been in existence for slightly longer than this, you'll see that since inception, it has outperformed the index by around 5%. But the key here is that the beta of this fund, similar to the global franchise, is significantly below 1. The Asia Pacific franchise GSF has a beta around 0.85. So it's creating this performance even in up markets during down periods. And again, it's about creating that certainty in uncertain periods. Next slide, please. So just to summarize, and here today we've been talking about global franchise and Asia Pacific franchise, but they follow the same philosophy. And what we're trying to prove here is that this high conviction approach is able to deliver long-term outperformance. As long as we maintain valuation discipline, which we do throughout the philosophy, the combination of resilient and sustainable growth has achieved very good performance. What we have is a global platform with people based in Cape Town, such as myself, in London, in New York, providing a deep and differentiated insight into an evolving investment universe. And that combination, we hope, will continue to provide strong returns within the capability. Thank you.
Thank you very, very much. That was really interesting. I think that our audience is going to profit very much from this way of showing the world. It's true that, I mean, we have several questions, quite a lot of them, and probably it's a good time to start this Q&A session. You're going to see that many questions are more market oriented, let's say so. Even if you're asking for long-term patience and well, let's start by the first one, and you can get it from the equity and from the fixed income side. So it says, what is the role of fixed income, for example, in portfolios now that correlations with equities are positive? How can you build a portfolio to make this work? Maybe Brad, you can start, and then we can go to Charlie or to 91.
Yeah, let me start by saying I think people assume that correlations between equity and fixed income have always been negative. That's not the case. They've been more positive more often. We have UK data going back 300 years, and it's almost always been positive except for the last 20 years. Same in the US. That's been more a phenomenon that's happened as inflation has come down. But 40 years ago, fixed income was a big part of your portfolio. So just because your correlation now isn't negative, but maybe slightly positive, that doesn't mean you don't get a benefit from an asset that where the market's down 30 and you might only be down 1. Yes, now you're positively correlated, but still fixed income plays a role for income, for diversification, for ballast. So I don't think that that's a reason to abandon just because we're seeing some correlations change. They've changed all through history.
Charlie?
Yeah, I mean,
Charlie
I
can't
concur with that.
He's a freaking equity guy. I'm going to give you the answer from
No,
91.
but I concur in the sense that you will get periods where there will be correlation. Yeah, but over time they are distinctly uncorrelated. Particularly with the way we run money on an equity side, which is we try and very much differentiate it. Yeah, there will be periods where there is correlation, but over time, as I say, I think if you have a differentiated approach, as our the MFS guys were just saying, then that will create different return profiles, and therefore you can blend them quite successfully.
Okay, so maybe we can go into the interest for Asia and for China. We have several questions here. I'm going to try to put them together. It's true that the investors are looking for where to go next year instead of investing in well, the big technology stocks that have done so well, or this kind of sectors, and they're looking into Asia. We have a question. Maybe this one is for Richard. Some interest in this new Asia franchise fund. They want to know exactly when was it incepted, when did it start? And they also want to know how the recent regulation on Chinese technological firms may affect this portfolio. I guess they're thinking about the Ant IPO maybe, or the regulation or the different problems with Chinese firms in the United States.
So I'll answer the first question, then pass to Charlie. So the fund in Luxembourg was set up just over 2 years ago, but there is a UK fund within our OIC range, which is just about to have a 3-year anniversary. So Charlie's run that for, but it'll be about very soon, a 3-year track record. Yes, Charlie has created a 3-year track record for one, and the Asia Pacific Franchise Fund is set up on every platform, so you can buy it today. But now I'm going to pass back to Charlie. He'll talk to you about, Ant, the IPO, and other things about Alibaba, whatever.
I think we were probably one of the Asia Pacific franchises, probably one of the few Asian funds or even global funds not to apply for the Ant IPO. The simple reason there being that we only actually go for IPOs or stocks which we've seen through the cycle, and we understand exactly how they're going to perform and whether they do have that structural growth. There's no way of telling how Ant Financial would actually perform in a downturn in China, so that was the reason we didn't go for that. In terms of the regulation side, yes, it was a complete mess up with regards to timing and the pulling and suspension of the Ant IPO because of the regulation which was put in place. But I think on a long-term basis, it's very positive for China for 2 reasons. One, it's going to stop systemic risk within the credit markets in that it won't allow micro lending within the internet to get out of control, which could create systemic credit risk. And secondly, for the incumbents, it's actually going to create a regulatory hurdle and a barrier to entry, which means that the likes of Ant Financial or Weixin Pay, which is owned by Tencent, actually are now in a stronger position. With regards to the other regulation which has recently come in, which is the antitrust regulation, that's really following in line with what the US is bringing in place. And again, I don't think it's a big issue because I think regulation around those types of industries actually ends up being very positive for the incumbents because it raises the barrier to entry. So I remain positive on the sector on a longer term basis, but there could be some short-term volatility.
Thank you. Let's look into the United States and the elections. I know, Brad, that you told us that sometimes the promises that presidents make don't get through, but I have a very direct question. Do you think there is going to be inflation, or not in the next months or years? How can you position your portfolios for what's going to happen in the fixed income markets, especially in the United States in 2021?
Yes, hopefully you can hear me. The video shows that my face is still down.
We can hear you.
Great, there we are. We do think that there will be inflation at the longer, inflation and rates rising at the long end of the curve. The Federal Reserve is locked in the short end of the curve, but you add this massive monetary, you add in even some of this Biden inflationary policy, and we do think there'll be some inflation. So we think that the risk to fixed income portfolios are longer duration products. We think there's opportunity today over the next year in short duration, high quality. Avoid high yield, keep it short duration, maybe 0 to 5. You're not giving up that much yield anyways on an absolute basis. And in case we do get inflation, you have 3 times the protection you have than an intermediate or even a longer term bond fund.
Okay, and another question for you, Brad. In terms of the global positioning of the strategy you were talking about, are you going out of the United States and investing in other regions? Are you more invested now in Asia, in Europe? Can you tell us a little bit about that?
Yeah, no, it's a global fund. We love the periphery in Europe. Obviously there's a lot of U.S. bonds in there, but even emerging market debt is an area that we flexed into. Be it Dominican Republic, Egypt, Greece on the developed side. Greece was an area in Portugal that we flexed heavily into a year ago, made a ton of money there. So that periphery has been very profitable for us in Europe. And then we can flex between securitized, corporate, sovereign, and in securitized right now, there is some opportunity there as well. So global, anywhere in the world, any sector, any currency, any credit quality is what the fund can do.
Okay,
hey, Brad, can you hear me? Alicia, can you hear me?
I can. Yes.
Yeah, just a question that I know, you're getting questions, Alicia. I'm getting a few questions as well on my end on the role of tips. Because again, we're thinking about inflation. We're thinking also about how to maybe structure the portfolios as we move forward. But there's a couple of things. One, inflation is definitely a high duration asset class. And so what role will it play, Brad, in this sort of new context that we're going into?
I think it's a great role. And for one, you're getting it at a cheap price right now. So that inflation protection is cheap relative to history. So why wouldn't you add that into your funds right now at a cheap valuation? Will it happen next year? I'm not sure. But if you can buy a cheap asset and wait for it for the benefit, I think it's a no-brainer. So we think tips right now are a good buy in portfolios because they're so cheap.
Perfect.
Okay, I have another question. Maybe this one is more for 91 for the quality equities. Now that Biden has been elected, are you expecting that the climate change comes back to focus, and will it be so globally or more in the United States than before? Maybe we can look at Asia for this.
So, I think, climate change and making sure that sustainability is back on the table is going to be at the forefront of Biden's policy. I think that's positive for the world. Certainly with the way we invest is looking at sustainability. You're looking at an average holding period in the funds that we operate of 5 years plus. So if it isn't sustainable on a business model basis, a financial model, or capital allocation, but within that, what it's doing to the environment in terms of, is it pollutive? How does it treat its suppliers? Is it overcharging? I think it's going to go straight back towards how it was pre-Trump in terms of really making sure that sustainability and making sure that we're doing the best to dampen climate change and move back towards the rhetoric was just created before Trump.
Okay, I have one more question for MFS, and then, Richard, go ahead.
I just want to give some context for people listening, because it's been very interesting looking at the interest in climate change. We have a global environment fund, And we've seen huge demand for it in the UK and Europe. And the question's always been, what about the US? What about South America? And literally, I would say in the last months, it's just picked up. Maybe it's because of the election, but there's such interest now in decarbonization, in climate change. And to me, what's going to happen in the next 2 or 3 years is that, first of all, on the ESG side, every fund will have to be an ESG or sustainable fund, but the thematic ideas behind decarbonization, about climate change, but there's so much money that's got to be spent on it, is going to see demand go literally vertical.
Yes, Richard, I totally agree. We've seen that too in the clicks on our website. We're seeing a lot of interest now from the Americas. Before it was mainly in Europe. To that question for MFS, I don't know who's going to take this. Maybe Jose or maybe Brad. Okay, what range of returns should investors with a moderate risk profile expect for 2021? There's always this hard question to answer.
It's tough. I mean, if you look at nominal yields today, and you know, and then you look at where valuations are in equity, you know, we can't venture out to say. I mean, just think about this year. Would you ever thought that we would be at the levels we are today in the market, both in fixed income and equity, knowing everything that happened in March through now? I mean, this is unprecedented. I believe what people need to, and investors really need to think about is having a realistic, you know, view of their portfolios to the lens, and to really engage with their, you know, advisors and their private bankers, and to really have a, you know, a sincere conversation about the fact that, you know, we have a market that is, you know, in our eyes continues to be, you know, at high levels. We have also, you know, a contracting, you know, spreads in fixed income. So where is the alpha going to be generated? You're going to have to, number one, be, you know, active in your approach. So I think that's really one great thing for managers like MFS and 91 and others. And two is that the topic of sustainability is also very important, because I think that, you know, at MFS, this is all an integrated process of our investment, you know, management process. We don't really, you know, silo sustainability. And of course, that's going to have a, you know, important part in the materiality and the results of companies. And of course, that again will have a result, that, you know, direct result in alpha generation. So if you look at ranges of what you could be in a moderate investor, you know, you can go back and look at, you know, historical returns, you know, in the last 20 years. Fixed income used to give you 7, 8, 9%, you know, and if you look at what fixed income gives you today, it's very little. So I think that not only has complexity and risk has come, you know, has moved, you know, into a far much more complicated scenario for investors, because to generate a 7.5% return today is going to probably get your standard deviation to be much higher, and the degree of you using just fixed income and just equities are going to probably not get you there. You might need to have commodities, FX, and many other things to get you to maybe a return that you feel maybe what you're looking for. Not sure, Brad, you want to ask anything on your end? Of course, 91 also would be welcome your comments.
Yeah, I'll just add, I think you get anywhere from 5% on fixed income to negative 25. Listen, it depends on where you're invested, right? I mean, yeah. If you're invested in high yield, you know, longer bonds, you're going to take it on the chin. There's a chance of that, or you might get 5%. If you can dial it down to short duration, high quality assets, where your range of outcomes is very smaller, it's more like 3.5% to negative 2%, and that's why I think that's the call. I'll also just make the statement: this is where active management, an alpha of 1% on top of a 2% benchmark is 50% alpha. That alpha this coming year will be significant as a proportion of the return you're generating.
Thank you very much. So I think that Jose and Brad, you've answered already the last question we have, which is how has your portfolio changed during the year 2020? Maybe Charlie, you can give us a look of how has it changed for your quality franchise.
Across the portfolios, there's actually been very little change, and that's what you'd expect with the type of companies that we invest in. So that even when COVID-19 occurred, when the pandemic came in, You saw some businesses under extreme stress, as I'm sure you'll see in the debt market and the credit markets. Because we don't invest in companies with balance sheet stress, we invest in companies with high levels of cash flow. Actually, there was very little change we made, what I'd call on the negative side, where we were worried about companies in the portfolio. What we did see, though, is obviously with the dislocation in markets that we have seen during the year, it did allow us to buy stocks which we've been very keen on buying because they'd had fantastic quality, very good growth, but the valuation had been too extreme. And obviously, when you got that level of dislocation, it enabled us to buy those businesses at very attractive valuations.
Well, thank you very much. I think, yeah, we've made this a little bit longer, but I think we have to end it now. I want to really thank you. Apologize for any technical difficulties we had. Brad, Jose, Charlie, Richard, it has been a pleasure having you here. I just want to let you know that this has been recorded. We will be sending the recording to all our buy-side database, so they will be receiving your remarks. And if you want to, we can also include the presentations, or I'm sure that you can reach out and send the presentations to those investors that want them, that ask for them. They normally do. So thank you very much, and hope to see you soon in a new Virtual Investment Summit by Fan Society.